Talk to us about what was cautious and muted in 2022 now turns to constructive after a brutal last year, Mark. Some of your best ideas, and one of them is Uber. It's interesting, we just finished a conversation hot on the heels of Tesla, of robo-taxis. What fundamentally looks nice to you with Uber, Mark?
Well, Caroline, thanks and Happy New Year to you. It's nice to see you again. This last year was a terrible year. It was the worst performing year for stocks, especially for growth equities, since 2008. So yeah, that was very challenging. Going into this year, we try to be tactically constructive, which means we're looking for companies that are somewhat recession resistant. And I don't cover a defensive space, so somewhat recession resistant, maybe have new revenue streams, and then have taken cost actions because you need to do that if demand is going to soften. And that leads us to like two stocks in particular. You mentioned one, Uber, the other is Netflix. Uber, I just think that the ride sharing part of the business is more of a utility than a discretionary spend environment. We still need to commute. We still have our weekend outings, and we still have some airport trips, and leisure demand trends seem to be holding up very well. So I just think that that part of the business holds up well. Company has taken a lot of costs out. It was forced to, and it was probably to its own benefit. And they've now turned a corner on free cash flow, and I think they'll be able to continue to grow free cash flow. So I think as the story changes from a growth at all cost company to a positive free cash flow company, I just think that you're going to find a lot of valuation support for the name, and that's why I think the stock can outperform this year.
It's interesting, just there already you're getting to the nuts and the bolts, the fundamentals, the decisions why you're picking certain companies to perform over and above others. Do you think it's true that a lot of technology investors out there haven't done their fundamental analysis, or indeed aren't able and set up for an environment that is completely at odds with what they've been used to, which is basically lower rates for longer?
There's no question in that easy money time, with practically zero interest rates, allowed multiples for one to get in times very aggressive, and there was a fools follow fools, and I was certainly one of those fools from time to time on certain stocks. We all make mistakes. I've made more than my share of them. But in terms of the fundamentals, I still stick with those, and I think a lot of tech investors do. I don't think that it's rising interest rates that has caused names like Amazon or Google or Meta to underperform as stocks. I think there are other issues, including now increasingly cyclical risk. In case of Meta, there were these Apple privacy changes. In the case of Amazon, there's also some misexecution on their part, and then also just full exposure to inflationary concerns. So there really were a lot of issues besides just rising rates. Rising rates really affected those long-term profitable, near-term profit-less companies, and that would be more names like a Shopify, for example. And that's why you saw names like that with the highest multiples correct the most last year.
Mark, Caroline and I spent a lot of the last few weeks of the year talking about layoffs or hiring freezes, cost cutting. I'm trying to summarize all of your points there, but you seem to be suggesting that all the pain is gone, like it's been done. We've gone through it, we've de-risked. Is that your conclusion going into this year?
No, I wouldn't go that far. I wouldn't be that bold. Multiples have been de-risked. Could multiples still fall? Of course they could, but they have fallen pretty dramatically, and you've got a good number of these large cap internet names that I look at that are trading at 5-year trough multiples. Doesn't mean they can't go down further, but a lot of the risk has been taken out. The same thing with estimates, and one of the things that's caused estimates to come down are these companies taking costs out of their business. The 6% RIF reduction in force at DoorDash, the 13% RIF reduction in force at Meta. These companies, and Amazon did this too. There are companies that have yet to do this, though. Google is one where I just think they had 5 quarters in a row of accelerating in record high employee adds up through the September quarter of last year. That's really kind of a little bit shocking in hindsight. I'm surprised that the company didn't start tempering down its number of new employees. I think they're going to have to start, reducing that employee footprint, or else margin's going to be under a lot of pressure.
Mark, we took to Twitter to ask our audience how they see 2023. We asked, are you bullish on tech? Are you bearish on tech? These are the results. We'll bring them up for you. Mostly bullish, 46% of respondents bullish. What would it take to make you bullish on technology broadly going into the rest of the year?
Well, Ed, I'm actually surprised that the survey was that bullish, frankly. I'm surprised by that. So I want to be tactically constructive. And I'll tell you one thing, I still want to get across the point here. I think demand trends are going to continue to soften. They did in Q3. I think when the Q4 results come out over the next month, we're going to see that revenue trends for online retail, online advertising, cloud computing companies, those are all continue to soften. And I think they will continue to in the middle, through the middle of 23. Then I hope, and the market hopes, that fundamental trends stabilize, revenue growth starts to reaccelerate. If that happens, you'll start seeing multiples go up. And especially with cost taken out, you have revenue growth reacceleration on a lower cost base. You get this EPS slingshot opportunity. That's what's going to cause these stocks to work well. So the market's sort of hoping, thinking that that'll happen in the back half of 23.
Yes.
And the question we all need to ask ourselves is the market going to be too early or too late on that call?